Tech Innovator Asia Pacific, based here in Singapore. Again, a warm welcome to our second webinar in our series. Today's topic is fundraising, term sheets, and deal structuring. We have an outstanding panel joining us here today, and I'll come back to them in just a moment. Just a quick background for those of you who are watching on YouTube and on LinkedIn. We do host these webinars every Thursday at this time, 10 a.m. Singapore time. The first hour will be live streamed on YouTube and on LinkedIn, and we will then go into closed door Q&A just with our cohort companies. Next week's topic is going to be M&A and working with strategics. So that's another one that you do not want to miss. For those of you who may not be familiar with Medtech Innovator, just very quickly, we are the world's largest accelerator for startups in traditional medical devices, digital health, health tech, and in vitro diagnostics. By the end of this year, we will have had well over 600 companies globally that have gone through our accelerator program. Those companies have gone on to raise $7 billion in follow-on funding. So please get in touch with us directly if you'd like to apply for next year's program or be part of our ecosystem. Joining me here today, I have my Medtech Innovator colleagues, Bernice Tan and Ailet Marom. For our cohort, you're welcome to reach out to them directly if you got any challenges with audio or asking questions or any other questions you may have. So if for our cohort who are on this webinar, if you have questions to our panelists, please use either the chat function at the bottom of your screen, or you can raise your hand and we will queue up your questions and get to them later this morning. Right, well, let's get started. So we are very, very fortunate to have three highly distinguished panelists joining us today from Asia as well as from the US, and I'll have each of them introduce themselves in just a moment. We have Dr. John Kim, Managing Director from Aphelion Capital in the US. We have Daniel Teo, Managing Partner at Honeywell Lake Venture, also dialing in from the US. And here from Asia and based in Singapore is Ko Fong Ming, who is Investment Principal at Life Capital. So I will turn to my panelists, ask them to provide a brief introduction of themselves, tell us a little bit about your background, your company, and your role in the company. And also, if you have any particular investment focus or criteria of your firm in terms of stage, sector, maybe tell us a little bit about what those are and perhaps typically what your check size is. And let me start with Daniel.
Hi, thanks, Frederick. Hi, I'm Daniel Teo. I'm a founder and managing partner at Honeywell Lake Ventures. We are a Palo Alto, California-based medical device VC, where we're building a portfolio of companies with surgical innovations as a common theme. The kind of companies that we're looking for are in the cardiothoracic, cardiovascular space, in neurology, and also in the GI space. We're typically seeking, Series A, B, and C funding with typical check sizes of $1 to $5 million. Now that said, we have also invested more than $20 million into one single company called Picard Medical, which is building the next generation of total artificial heart technology on the back of an already approved FDA product and its existing technology. But this is atypical, so I would still go with the $1 to $5 million in most cases. Thank you.
Great, thanks for that, Daniel. And John, I'll turn to you.
Hey guys, so I've been helping out Medtech Innovator since the inception. Helping out Paul Grand for a while. I've been with Aphelion for over a decade. My background is I used to be an analyst on the sell side, covering all the strategics. But on the side, I also practice as a hospitalist once in a while to keep up my practice. And what we do at Aphelion is we look for medical devices, digital health. We've been focusing upon cardiovascular opportunities because one of our LPs is for one of the funds is the American Heart Association, and we have other LPs that also are want us to kind of take a look at the home health space as well. And so those are kind of our bigger buckets, but we'll pretty much look at everything as long as it sort of makes sense. We do seed, A, B, C. Check sizes usually 2 to 3 million per round, with powder to continue follow-on rounds as long as it takes. And yeah, so we have capital to deploy, and it's nice to meet you guys.
Thanks, John. And just a quick follow-up question, maybe to you, both to you and to Daniel, before I hand over to Fong Ming here. Are all of your portfolio companies US based, or do you invest outside of the US? John.
No, we have a couple of Canadian companies. We're looking at a couple of European companies, but most of them are US based because it's just a little easier. But
of course.
But yeah, we looked at a couple of Asian companies as well. But yeah, no limitations. But since we are in the US, it's just a lot easier to do the diligence here.
That makes sense. And Daniel, in your case?
Same with Honeywell, for the same reasons. Most of our investments are in the US, although we're not restricted to any particular geography. We have looked at companies in Europe, in Korea, and in Singapore as well, and in Israel. But so far, haven't made any investments. Oh, in Israel, we did make one, but otherwise, we have not made any other investments outside of the US. Not because we're restricted, but just the right opportunity hasn't turned up.
Right.
But for practical reasons, though, it's unlikely we're going to go into like too many countries, because each time you go into a new geography, you're going to have to look at the whole governance structure, the whole business practices, and all of that. And so there's a lot of investment in time in learning this new space. So unless we see that there are a couple of other companies that we may be investing in that country, we're unlikely to go there.
Yeah. We'll perhaps come back to this a little bit later on here in our discussion as well. Fong, I'll turn to you. Please introduce yourself, talk a bit about Life Capital and the types of companies you guys invest in.
Thanks, Frederick. Well, hi everybody. My name is Fong. I'm a principal with Life Capital in the Singapore office. So we are a global healthcare-focused growth stage VC fund. We have offices across the world. We have one in the US in Menlo Park. We have one covering China market based out of Shanghai. We have a Korean office out of Seoul, and of course, I'm in Singapore. Currently, we manage about $2 billion AUM. We have over 80 portfolio companies, and we invest quite broadly across the healthcare space, but only in healthcare. So we do biotech, so biopharma space, medical devices, diagnostics, and a lot of pharma supply chain as well. So myself, I'm a stem cell biologist by training. Actually, I spent about 10 years in California, got my degree from UCSD, UCSF, came back to Singapore, did investments for the last 4 or 5 years. But about investment ticket sizes, we actually invest quite broadly as a result of our fund, because our latest fund is over $900 million. So in the US, we do a lot of innovation deals, but not as early stage as Daniel and John. Probably do a Series A, about $5 to $20 million or higher. In Asia, especially, we do larger ticket sizes, even about $30 to $70 million. And recently started doing small scale buyouts as well. So the $100 to $200 million buyouts. We just completed one deal in Singapore just 2 months ago. So it's pretty broad, but in the end, I think we're very data driven. As long as the product has a good market for it, I think we're very happy to invest.
Yeah. And typically, where are your portfolio companies located?
So right now, our portfolio, about 2/3 are in Asia,
Mm-hmm.
1/3 in the US. As I said, the US companies are in more early stage. We have about 10-ish companies that's already IPO'd. We are still holding on to them. But in Asia, I think majority is in China. But we have a few portfolio companies in Korea, and we just have the latest one in Singapore.
Okay, excellent. Well, thank you all for that background. Let's before we dive into the details of practicalities of fundraising and term sheets and structuring deals. Let's just talk a little bit about the current fundraising environment. I saw that the HSBC Venture Healthcare report came out just recently, which used to be the Silicon Valley Bank report, and I believe we share that with our cohort companies as well. Looking at the first half of healthcare investment in US and Europe, my summary of their observations, I think they were saying essentially valuations have undergone a major reset, and overall it appears that healthcare investments are down significantly if you compare the first half of this year compared to the previous 3 years. Now, obviously that varies by sector. So I understand that pharma and digital health are down a lot more than traditional medical devices, for example. But I'd love to have your thoughts and views on the fundraising environment at the moment. And Feng, I'll turn to you first here. What are the funding trends that you're seeing in Asia across these three sectors? Traditional devices, health tech, and diagnostics?
I think it's a really difficult time right now for companies to raise, but also difficult for funds like us to deploy, because although you mentioned that valuations have undergone some sort of reset, but I think there's still a bit of overhang. I think a lot of companies in all of these different sectors, even though the valuations are quite high, but as long as existing shareholders can continue topping up to do bridge rounds, and we're seeing a lot of those bridge rounds, I think the valuation will maintain until the company gains some milestones to justify the valuation. Because I think it's very painful for investors right now to take new down rounds, right? Which is have to justify to our LPs. But as a growth stage investor, I mean, we've been looking mostly at the IPO market to take reference from there. And obviously the US IPO market, the first half is really slow. And in Asia, looking at China, it's extremely slow. And not just because of the general macro trend, but as well as very local China-specific policies, right? There's the geopolitical tension in the US. There's recently, just last week, they started an anti-corruption campaign again against some of these companies that are going public. So it's really dampened enthusiasm for IPOs. As a result, you can see that all later stage growth investors are also very careful with what they deploy. And all the US dollar denominated funds are also very cautious, right, to deploy. So I think in the end, Asia, looking at China, I think it's going to be complicated fundraising in the past and in the near future as well. Yeah.
No, that's the sense I get as well. So thanks for that perspective. That's very helpful. Let me turn to John here first, and then to Daniel. Your thoughts on, I don't know if you've read the report. Do you broadly share the views? What's the sentiment in the US at the moment?
Yeah, from my perspective, I mean, the first half of the year was it was a continuation and acceleration of the downslope from the prior year in 2022 with interest rates rising. It's difficult to kind of appropriately value companies, and it was more of a wait and see. And then with the banking issues, or back in March, April, that everybody was in a panic mode for a couple weeks. We're like, all of our companies are going to go under. We don't have cash, but luckily we got out of that to the other side. So again, there was a little bit of a shock and trying to reassess where everybody is within our portfolio companies, making sure that everybody had enough cash to, as Fong said, to meet their milestones. And I think, this first half of the year, at least, everybody's been just kind of hunkering down, redeploying capital back into their portfolio companies, making sure that they have another day to live. And then looking ahead at the second half of the year and just seeing, what, anybody is out there. But it feels like things are opening up a little bit more in preparation for the second half of the year. There is some inklings that the IPO market here might open up a little bit. The SPAC market might open up actually a little bit as well. So there is some rumblings that things are, as inflation gets under better control, as rates do not, exceedingly go up in a trajectory like they did for the last 12 months. I think people can hope that there's a little bit more stability and that we can start redeploying capital. And the good thing is that, like Daniel and I, we do earlier stage investments, and we can kind of ride out some of this through the next 5-10 years. But hoping that we can get some better priced more appropriately valued, more typically historically appropriately valued medical devices than they were in the last 12, 24 months.
Yeah, that's good feedback, and I'll turn to Daniel here in a moment as well. You mentioned the SPAC market, and I don't know if our viewers have may have seen in the news on the digital health side with Babylon going belly up, and of course the problems with Pear Therapeutics a few months ago. It's been a challenging time for that sector. It appears so with those two very visible organizations having problems. Daniel, your thoughts very quickly on the US market from your perspective.
Sure. I think I agree with the general sentiment. I mean, certainly the market is very depressed and difficult to both fundraise as well as for companies to seek funding. Our LPs certainly are more cautious in general across the board. They're slower with the wallet and asking more questions and requiring more validation. And from our investment, well, we're fortunate that none of our portfolio companies so far have experienced any down rounds, but the subsequent rounds of investment, they have not been at the valuations that we had hoped for. So they're generally the IRRs, at least the theoretical IRRs, are lower. I say theoretical because we haven't exited yet, right? So, but there is a lot of during COVID, of course, a lot of good work was suspended. Clinical trials were suspended. Visits to hospitals stopped. Sales teams couldn't make calls and all of that. All of that is working its way through the system now, and so we're beginning to see some of these companies who have managed through that period a little bit better than the others, being able to demonstrate some progress in their work, and those are the ones that will be exciting to watch in the days to come.
Very good. Well, that sounds promising, and yeah, we've started to see some of that happening as well with access to hospitals and restarts of clinical trials and so on happening. So that's of course good news. Well, let's talk a little bit more in a bit more detail about some of the challenges for startups in fundraising, and let me first of all ask you what you typically would look at in a compelling investment. Maybe refer to a deal that you've recently completed, and what specifically has excited you about that particular investment. What is a compelling investment to you? And Phong, maybe I'll turn to you first.
I think there's many check boxes that companies have to fill. I mean, they cannot miss anyone, but especially with the crowd today, I think very early stage startups, I do find that most of the founders come from tech backgrounds. So this is what I always say, right? I think the most compelling thing a tech background founder can tell me is knowing how you can make money. Because I do find that most of the tech-based founders, they focus so much on technology, they're very excited about it, but they may not know the commercialization pathways very well, may not know the commercial pain point very well. So I think you mentioned one of the examples, right? I recently met up with one of the portfolio companies of ours, which is Nuclex, which is a US-based company, early lung cancer diagnosis, where the space where many people are working on NGS technology is very expensive, very hard to roll out, but they've come up with a way to do PCR-based technology, very sensitive. They can scale up very fast. It's very suitable for early-based diagnostics for screening purposes. So when you speak to the founders, you do find that they understand the pathway really well. They know what kind of specific target population do you address. They know where the pricing will be attractive for payers. If you give me a complete package to know that beyond the technology, you know how to commercialize the product, I think it gives me comfort that you have the complete package, not just focusing on the technology itself.
Thanks for that. That's helpful. John, what makes a compelling investment for Aphelion?
Right now, I am looking at things that are trying to reduce workforce. Again, I'm in the hospital, a couple of times a month. Our biggest pain point in the hospital is staffing. We don't have enough nurses. We don't have enough docs. There's a lot of strikes going on because there's a lot of anger with, over the past 3 years, nurses have been beaten down. They've been overworked, lots of overtime, not a lot of breaks, and their pay has been somewhat stagnant. And so, especially in this area, there's been a couple of strikes, both with like Providence, Kaiser, And so anything that improves workflow, reduces burden, nursing time, reduces FTEs, are stuff that I am, particularly interested in. And again, things that that have focus upon cardiovascular are pretty intriguing. So yeah, things that again, a lot of software that may improve workflow, a lot of software plus services, or a lot of software plus tech plus services that will kind of cut down workflow by 30-40%, or remove 2, 3, 4 FTEs from the workplace, or removes technologists and allows other people, non-specialty folks, to come in, are technologies that I'm particularly interested in. So we have a couple of them in our pipeline. Again, the first half of the year has been kind of crazy, and so we're actually trying to wait until prices come down a little bit before we strike. But again, those are the areas that I'm particularly think that are going to do pretty well over the next couple of years.
Great, thanks for that. And Daniel, your thoughts on what makes a compelling investment for you?
Yeah, I mean, you often hear people say that they are either seeking or deploying transformational technology, right?
Right.
That's a buzzword that we always use. But I think what they mean, though, and what we are really looking for, is seeking creative and transformational ways to deploy a proven technology, or a combination of proven technology. The truly transformational moonshot technologies, while very exciting and romantic, are also full of risk.
Yeah.
And unless you've got very good validation, you're going to find it hard and difficult to get anyone to finance that. I mean, let's take an example from a different space, natural language processing, neural network, AI, ChatGPT. I mean, those are the buzzwords and the talk of the town here in the Silicon Valley the last couple of years. But none of these are really transformational inventions that appeared out of nowhere. These have roots in Noam Chomsky's work in the 50s, the Adeline and the Medellin network at Stanford in the 70s, and Marvin Minsky's work at MIT Innovation Labs in the 80s. So these are all actually old technologies, but what happened is that suddenly everything was unlocked because computing power is finally fast enough to be able to enable practical applications of the masses. So likewise with medical devices, it takes a certain talent to be able to use a combination of simple, proven technologies, but then put them together in a way that no one else has ever thought of. So one example, one of the companies in our portfolio is called MTech Inc. And what they have is they've creatively put together, magnetic technology and ultrasound technology, and combine them together and use them to guide a device for gastric tube insertion, making it far more safer, faster, and more efficient. And it doesn't have to be high tech. Simple things like that do make a difference in the hospitals, and we like companies like that.
Yep, great feedback there. Thanks for that. Fong, turning to you, what typically do you see as key milestones that drive value in a company, and where typically should a medtech company be by the time they get to a Series A, maybe in terms of evidence, in terms of market traction, or health economics?
Firstly, I think Series A in the US is very different from Series A in Asia. I think the fund sizing, the round sizes here are very small, so you take many more rounds to get the same stage. But overall, I think we really focus on data, whether it's animal data of sufficient scale, or early clinical human data, first-in-human data. I think that's something that they really need to have and get to the right numbers to give confidence that this has some advantage over existing solutions. Because oftentimes, I think a lot of the data that I've seen it from the early stage companies tend to be not sufficiently sample sized enough. So I think it gives always some doubts, or it's not designed properly as to whether it's actually better than existing solutions or not.
Got it. A question we get very often from our cohort companies is whether it makes sense to take investments from strategics early on. And maybe I'll turn to Daniel here first on this. Do you typically co-invest? Does Honeywell Lake Ventures typically co-invest with strategics? I assume you co-invest with other institutional investors, and where you do invest with strategics, are there any concerns or anything that any advice you'd like to give to the startups? Is there a risk of having a strategic come in too early as an investor in one of your portfolio companies?
Sure. I mean, not only do we co-invest with other institutional investors, we absolutely welcome and encourage that, right? Because it's not only a validation of our own assessment, it expands the pool or the breadth of support that a startup is able to receive. They're getting help from more sources. We can't be everywhere all the time, and the more institutional investors there are, the more help they can get. Similarly with strategic, there's nothing inherently wrong with cultivating a relationship with and getting support from a strategic. The concern is less with the timing and probably more with the amount of influence the strategic may exert over a startup. So for instance, if a strategic came in too early in your investment stage, you're more likely to take a large position. And then, unless they're diluted, if they continue and exercise their preemptive rights and rights of first refusal, you may end up with a strategic having a dominant voice in your board and corporate decision making. And that may restrict your options to exit at the most favorable valuations, because that effectively rules out other strategic who may be interested in an acquisition later down the road.
Yeah.
So if that happens, smart investors will be more cautious and probably think twice before investing. So strategics, yes, but just be careful about how you position them and how much voice they actually get in your decision making.
Right. Thanks for that. And John, what's your take on working with strategics and getting them in to co-invest early on in some of your portfolio companies?
Usually it's always a good sign, because these strategics have been around for quite some time. They know how to behave with the early startups nowadays, and they don't want to be messing around. They want to help, and they want you to be successful. And for the most part, they don't put in things that are egregious in terms of rights at this stage. And so especially in this environment, any capital is good. And for the most part, they usually, like at this early stage, they don't want to take too big of a size, otherwise they'll have to report it as part of their balance. They want a small size, they want to play nice. They sometimes allow other strategics to come in to have a look and to kind of create a syndicate around the table. But if that's the case, that means it's a good sign that your technology is really interesting and of need to these strategics, and they see it down the pipeline as something that they could shove into their portfolio of products. So yeah, as long as you have a good lawyer and making sure that you're well protected down the road, I do. These guys, they all been around this arena for quite some time and know exactly how to play it. And so I'm not too worried about coming in too early.
Good, thanks for that. Phong, let's talk a little bit about red flags and concerns that when you see a pitch, what are some red flags that would sort of ensure that you'd really never want to invest in that particular company?
I'm not sure I've seen many of them, but I think I can give you two examples. One is,
please,
disagreements between team members when they're talking to you, when they're pitching over each other. It goes to show that management team don't have a unified vision of where the company wants to be. So that's more common. Recently, I actually met a company where the company is very profitable, medical device manufacturing and novel products. But the problem is that a lot of its revenue, significant chunk, comes from Russia.
Okay.
Unfortunately, in this current market, there are some certain markets where you can actually sell at a very big EBITDA margin. So I think, but for some certain investors, you need no investor background. For us, it'll be a concern for our LPs, and this is a deal that we cannot do, even though it's a very lucrative on the surface. So I think these are the high level of red flags that I may be more sensitive to.
Right. Daniel, red flags for Honeywell?
Often, we're a little bit more cautious when we see pure engineering teams with minimal clinical involvement of inputs. You always want to have a clinician, not just as an occasional consultant, but preferably as a member of the core team vested in the success, because otherwise we worry that it may be engineers building a device that they're trying to sell as opposed to identifying a clinical need and then building a device to meet those needs. We're also cautious when we see business plans that spend money on sales and marketing well ahead of the curve. So before you're making money, you're already hiring a 10-man, $2 million commercial team. That worries us. We like to see teams prove their market in small segments or small geographies before you expand the team to try and boil the ocean.
Good feedback. And John, any particular red flags for you at Aphelia?
Debt. Anything with a lot of debt on it.
Okay.
Not necessarily red flags, but like founders that are doctors that are like, we get a bunch of cardiologists that says they're gonna be CEOs of the company. It's really hard to do two jobs at the same time. Got to put in 100% into your company. You can't kind of half-ass it. You got to dive in completely, and you can't have like 50-50 doing 4 days a week in the hospital as a cardiologist and the rest of the time at night trying to run a company. It's really hard. Yeah, I mean, you see everything when you see enough of these companies. So sometimes the red flags, you can kind of think ahead and see how you can kind of mitigate some of that. Other times you just can't predict what's going to happen, and you wish that you could have seen some of those red flags beforehand until you actually get in there and see how the board kind of handles itself, how the CEO interacts with the board, how the CEO interacts with management, and how they actually spend. And so again, you can you try to mitigate that by making sure that they have enough counseling, have enough folks like within the Medtech Innovator that does a lot of this to try to train the CEOs and management on what to do, what not to do, how to build your market, how to build your models, how to pitch appropriately, how to reduce conflicts, things like that I think all companies should do to try to make sure that they have the best shot at winning.
Right.
So those are a couple of things.
Okay, no, that's helpful. Thanks, John. Quick comment to our cohort: feel free to put your questions in the Q&A, or raise your hand, and we'll take them a little bit later on. So you're welcome to start to queue up your questions now as we speak. Fong, quick question about SAFE. Or for those of you on watching who may not be familiar with the SAFE, it's essentially I think it's simple agreement for future equity, if I'm not mistaken. Common tool used these days. Is that something that you encourage entrepreneurs to use, and is there a place for SAFEs later on in later rounds in your view, Fong?
For SAFE, I mean, I see the value of it and why it was created in the first place. I think if it's a friends and family round, they are investing because they like you, not because they know the business. I think SAFEs are okay. But I see very unusual, uncommon for SAFE to be used in later rounds, especially bigger rounds with institutional investors, because definitive agreements, even though they're complicated and long, they're there for a reason. Every clause is there because someone got burnt in a certain situation, right? So you want to have the discussion upfront. It's like a dating process as you negotiate through all the terms. And if you save that and save the time, you're just pushing the problems to later on, right? So you have to just resolve your concerns and the alignment right from the start. I think the agreements, which is long, which will be helpful for the process.
Right. Daniel, how common are SAFEs in the US, and is it something you see in later rounds?
I think the situation is very similar to what Fong described.
Okay.
They're attractive to early startups because they're easy to execute and there's no pressure of repayment, right? So it's not like a convertible. It's not like a debt where you have to pay back that money. But in later stages, especially when you're bigger check sizes, from institutional investors, they are going to demand more sophisticated instruments because they have professional investors, they have LPs to answer to, and so they need to have these other safeguards. Also, if you're thinking of using SAFE as a bridge to an institutional round, consider the increased dilutive effect and complexity it might add to your fundraising process. So generally, in later rounds, SAFEs are rare.
Right. Thanks for that. Staying with you, Daniel, on this, we get a what we've done at the beginning of each webinar series is we survey our cohort startups, and they get to ask some questions about specific topics. So some of these are questions that they provided us earlier, and there've been a few questions about crowdfunding. And what's your perspective on that, Daniel? I know there are different crowdfunding organizations that turn to angel networks and healthcare professionals and so on. Is it a realistic option for healthcare startups to consider? What are some of the pros and cons?
I think it's got to be on a case by case basis. I mean, if you have a device or product that has a retail element to it, right? There is some consumer appeal to it. People understand it easily. Then crowdfunding could be a very exciting potential, at least in the early stages, right? Because people can identify, they know what you're investing into. But if you're investing into a sophisticated device, you'll be lost in the crowdfunding space there. As far as getting investments from angel networks and healthcare professionals, many of these are very educated professionals, right? You've got physicians with real expertise in these networks. And it's never a bad idea to have these investors in your cap table, because they're also a good validation of especially if they happen to be, your cardiology device and you have a whole bunch of cardiologists investing in you, that's a good sign.
That makes sense. And while we're on the topic here of cap table, and John, I'll turn to you on this one. Another question from one of our startups that they raised with us is they recognize that one of their weaknesses is a very fragmented cap table. How big a concern is that to you as an investor when you're doing your due diligence and you see a very long and very messy cap table? Is that a major concern? And typically, what can a startup do to optimize that?
It's only a concern if they're all preferred. If it's a messy cap table and it's mostly commons, and the CEO has a handle on them and is able to find ways to communicate with them relatively easily. But if he doesn't know who these folks are and he's having trouble corralling them, then it can be an issue. But for the most part, we basically look mainly upon like the preferreds and the rounds that actually matter in terms of voting and board compositions and things like that. So if it is messy in terms of like later, who's on the preferred and how do you, separate, if it's like, A, B, C, D, E, and there's a lot of debt in there in between dispersed around, and there's, very complicated voting arrangements, then you want to clean that up and make sure that that's cleaned before you put that term sheet in. But if it's just like hundreds of common investors, that's expected, and if they can make sure that they can manage those, and the investors from the commons understand that they may not be able to hear from the CEO all the time, and there is a feasible way to communicate with them easily. I don't think it's that big of an issue.
Okay, thanks. Fong, what's sort of the Asian perspective on cap tables and
so I mean, I do think that in Southeast Asia, I do think we do see larger cap tables because fundraising is more difficult at early stage. There aren't that many early stage VCs. So I think it depends on the reason behind it, right? So because of fundraising at the friends and family round, I think it's not a big issue. Just administratively, signing an SHA and new rounds is complicated. So eventually, some VC will say, you know what, put everybody in SPV, right, to make it easier. But I think it's more concerning, and I've seen it before, where you find that a company raising large rounds and you have many VCs participating, but everybody with a tiny check. That raises red flag to me, because it shows that nobody's really confident to put a big check behind the company. Nobody's really bothering much with it, because just putting in to just see how the company develops, but not enough to spend time and to be affiliated and close to and be responsible for the company. I think in that case, I'll be a lot more concerned with why the rest of the investors are not confident in the company.
Yeah, no, that's good feedback. Daniel, yeah, please.
Yeah, if I may, I think one of the issues that, or one of the problems that a fragmented cap table brings to the companies, it could become a distraction to the management, right? I was once involved with a board member for a small company that only 5 employees, but 1,000 shareholders. And so, a single activist shareholder with minimal holdings can distract the whole board for weeks ahead of our annual meeting at AGM. So imagine having to explain different things to different dozens of different shareholders. It can really distract management. But there are ways to manage this through consolidating the shareholding, by buyback programs or secondary sales program through a new investor, for instance. There are also digital solutions. I'm not being paid to say this, but take a look at software like Carter, CapShare, Global Shares. They can help make your shareholder management a lot easier.
Great feedback there. Thanks for that. Let's take maybe a closer look at some of the term sheet terms, and I'll turn to John perhaps first on this. In a term sheet, typically there'll be some critical but maybe less obvious items. What are maybe the top 2 or 3 critical terms or items in a term sheet for you? And maybe you could tell us a little bit about why they're so critical.
I guess on the term, valuation is always, up there. Board structure, who gets voting rights, what's the cutoffs for voting, how much, who's on your side and, who's on management sides, what are the, do we have enough around the table to actually change things? Yeah, those are the top things that I just mainly look for. Everything else, you don't want to make a term sheet too complicated, or else it's going to complicate, your relationship. You want it to be, very standard in VCA terms. Again, because the more complicated it gets, the more you're wondering, is somebody hiding something, or why are they putting this in? Why is he, does he not trust me that I'm going to actually get to my milestones? Why is he putting like 4 tranches in? And is he going to be just, he's only going to give me like $50,000 every month to get to my milestones? Things like that. Just, yeah. So I would say if you trust your technology and your company, and you trust the investors that are coming in, they should, provide you with a relatively standard term sheet with, attractive valuations for either both, that you feel is reasonable, and a voting and a board structure that is helpful and not destructive, like, just having like 2 or 3 board members doing all the work, for a larger company. Just, right size the board, make sure that the voting is adequate, and just don't make it too complicated. Otherwise, it's gonna, probably bite you in the butt later on.
Right. Fong, your thoughts on critical items in the term sheet for you?
Everything that John said, but I think there's one more thing that not so much applicable for my current fund, because it's more growth stage, but previously was an early stage fund. I think good lever, bad lever clauses is something that's often ignored. And once you get experience of that, I think you want to put it in. Because the way I see a term sheet, when things are going well, you don't care about what happens in the term sheet, right? The term sheet is really about downside protection and what happens when things don't go well. And a good leaver, bad leaver clause is kind of like a prenuptial agreement that you discuss up front, because you're in the early stage investment, really betting on the founder as much as the technology. And if the founder at some point after investment decides that, you know what, I don't want to do this anymore, it's too hard, what happens to the shares, the controls? If there are multiple founders, if they decide to have a breakup, right? What do you do with it, right? I think those are things we need to discuss upfront to minimize downside when if unfortunately things happen and in the startup environment it's really stressful. People do break. We want to know upfront, right? To have clarity so everybody knows how to move forward in a more amicable way. So I'll say good leaver, bad leaver.
Right. Daniel, your anything you want to add to this?
I would add to that, to startup founders and CEOs, if you're ever presented with a term sheet, take a close look at the participation right section. Understand the differences between participating preferred and non-participating preferred. They can make a huge difference to your valuations and to your exits. Also understand the difference between, see closely how right of first refusal or preemptive rights are worded and defined. For instance, you're going to find it difficult. No institutional investor is going to invest time and effort to do due diligence and negotiate terms and documentation if you have a preemptive right that allows an existing shareholder to preempt them and trump everything, right? On the day before they close, for instance. So just watch out for some of these and understand the differences.
That's great feedback. We had a question earlier on the ESOP pool, the employee stock ownership plan. Fong, in Asia, typically for a Series A, what's the standard ESOP pool percentage that you see amongst your portfolio companies?
I think it really varies.
Okay.
Because it depends on how much a founder or the founding team holds and how much you need to reward everybody else, right? So if it's a pool of founders and they all hold significant shares, the ESOP pool becomes something smaller. But if there are a lot of employees who are critical to the future of the company, of course, you want to get a bigger one. So I'll say like 5-10% would be something that you would definitely see at this point in time.
Right. And John, are those similar numbers you see in the US as well?
Yeah, we try to advocate more.
Right.
The bigger the ESOP pool, the better for us. Right?
Okay.
Because again, we'll try to negotiate. Obviously, it's going to be a dance, between management.
Yeah.
Obviously they don't want it to be too large, but for us, if we can get away with 10-20%, yeah, heck yeah. But if again, and then you usually whittle it down, and it's anywhere between usually 9 to 15%. Is what we typically end up with. Because again, if it's a small team early, you want to make sure that you have enough options around the table to bring in additional management. If there's problems, you want to bring really good experienced folks, and to be able to incentivize their sales reps or whatever, or additional hires that down the line. So you make sure you can calculate what your hiring process is going to be, and you leave enough for emergencies.
Makes sense. Daniel, what percent typically, from your perspective, does Honeywell Lake Ventures or VCs in general see executive founders retain to demonstrate the engagement and in the business and to incentivize them?
Okay, and this follows on from what John said, right? That you want to make sure that they have enough skin in the game.
Yeah.
If they're diluted to a point of insignificance, they're basically employees, right? They're no longer motivated as founders to drive their business. So something in the range of about 20 to 25% would be a good point for them. But again, it depends on how big that company is and what sort of valuations they're looking at.
Yeah.
Is this $1 billion company? Then that's a huge stake.
True.
If this is a $100 million company, then again, you want to give them enough skin in the game to keep them going.
Makes sense. So let's talk about valuations a little bit. Do you typically, are you open to have startups come to you with their expectation on valuation, or is that something would you recommend to startups not to indicate what their valuation expectation is? Fong, you're smiling. What's your thought on that?
It's kind of like salary negotiations when you discuss
Right.
valuations. Personally, I do like it when startup founders give a number.
Yeah.
Because if the number is too far off from what I think the company is worth, I think it's good to share so that we don't have to waste time going forward. It also gives me a sense of how in touch the founder is with the general ecosystem. But I mean, it's just a reference. In the end, internally, we also have ways to calculate and what we think is a reasonable one for us to make our returns, and just making sure that what we are expecting matches what the founders expect.
Right. And typically, from your perspective, Fong, what are some of the key factors that you take into account when you look at valuing a company at different stages?
In the end, I think for us, we see like a relay. Early stage investors invest, they pass it on to us, growth stage, and then maybe there'll be one more round of pre-IPO investors, and then they go for IPO. And you can work backwards, right? Everybody has expectations of returns. So in the end, if your eventual market size and pricing and revenue is of a big market, everything can be bigger. Of course, you risk adjust for that. But that's one way, and that's the way I prefer it. During the bubble times, of course, all the valuations are all inflated. If you do it that way, then maybe it's very hard to do any deals at all. But it's going to be a balance between all the different methods. Makes sense.
Daniel, do you like to have companies come to you with their expectation of valuations?
Yeah, I mean, that's helpful, but more important than the actual number itself, what we really want to see is to understand how they've arrived at that number, right? If you just give me a number that you've plucked out from the air, that's not very helpful. But I want to see how you have arrived at it, what assumptions you have used to get that number. And then that helps me understand, or helps us understand, how well-grounded they are in the reality, as Fong says. And besides, we can then use those assumptions and rebuild our own model, and then we can have our own number there.
Thanks. And John, your perspective on that, on valuations and some of the things that you look at?
You look at the market, look at what the market's doing, because sometimes, like in an environment like this, they're always going to come back. So you just can be patient and say, hey, this is our offer. This is how we calculate it. Yeah, like Dan says, we typically do our own calculations because a lot of the founders put in very high expectations of what they're going to be doing. Once they do commercial, it's the typical hockey stick, and we yell at them and say, hey, bring it down. And despite bringing it down, and then historically they never meet their expectations or their budgets, and so again we slash it as much as we can to at least build a very good ground up model. We try not to do a top down, but again, our most realistic expectations are always from going account by account, doctor by doctor, patient by patient, geography by geography, sales rep by sales rep, and building our really good model from, and you just keep doing that, and then you show it to the founders and the entrepreneurs. Hey, this is how we got here. This is our this is from our experience. And this is how we, came up with our valuation with some type of multiples, and then you compare it to other public entities and see what they're, showing and what they're trading at, and to tell them, hey, this is how it is. Take it or leave it. And for the most part, if they leave it, they usually come back as well, because everybody else is creating their models too, and trying to get to expectations that are more reasonable. And so again, it's all a dance,
Right.
And no one's perfect, but again, it's really hard. I mean, 99% of this is execution, and it's really hard for entrepreneurs to change from having a technology and then turning it onto a commercial entity, and we just haven't seen that type of really good traction, except for like folks that have done this before and they know exactly what they're doing. And so yeah, don't be offended if we come back again with a really low valuation. It's always a dance.
Yeah, no, that makes sense. Daniel, any terms in the term sheet that are completely non-negotiable for you when you make investments?
I think when you have got institutional investors, you're gonna have to expect liquidation preferences. Your investors are always want to be paid on liquidation before the founders and the employees are the common shares. And the B round will always want to be paid before the A round, so on and so forth. So that's pretty much industry standard. The other one is information rights. Everyone will want information because they've got reporting obligations to their funds and their LPs. Though this is rarely challenged. I don't see anyone having issues with that unless they're like, excessively onerous. Preemptive rights I talked about. If you have a major shareholder or major investor, they may want drag along rights to make sure that when they decide to sell or exit the business and have a strategic buyer, then everybody else is compelled to go along with that deal. So those are the things that are generally you're going to see that on any term sheet.
Yeah, great. Fong, your thoughts on non-negotiable terms?
I think by this time, the industry has been so mature that there's a standard template term sheet going around. I think what's so far in the discussions, I think every time I think it's always negotiable, as long as you're being reasonable about it, right? So seeing each other's point of view. Some things like info right, like what Daniel mentioned, I mean, we need it. So I think as long as the founders can see why we want it, and if the founders asking for something and it has an explanation for it, we can support it as much as we can. But I think everything can be discussed.
Right. Gentlemen, we have 2 minutes left. This time flies here. So as a wrap up, what I'd like to ask each of you is maybe share some of your final thoughts, reflecting on some of the things that we've talked about. Maybe any tips or advice, any final tips or advice you'd like to give the startups that are watching the webinar, and maybe John, I'll turn to you first.
Tips would be, take the lessons that you learn from Medtech Innovator, take them to heart, because again, it's a wealth of knowledge and a lot of, again, there's a lot of strategics that can provide a lot of knowledge and guidance. So just take advantage of that, because again, once you leave, you're not going to have that, and or maybe will if you keep the Rolodex of contacts, but. Just take all the advice that you can and keep plugging away. It's never easy, but it's it'll be worth it. In the end, once you get out and do the fun stuff, is being able to sell and see your product actually out in the field.
Thanks for that plug, John. Appreciate it. Fong, any final words from you?
I would say that, these are difficult times for fundraising for startups in general, due to macroeconomic conditions. But just to remind everybody, the industry is cyclical. So we had our bubble, we had the bust, and soon we'll come back again. So I think everybody should just have faith and keep on plugging at what you're passionate about. And someday, you'll see the sunlight, at the end of the day.
Great advice. And Daniel, final thoughts.
I echo both John and Fong's points. To all the brave entrepreneurs out there, avail yourself to good advice, persevere in what you're doing, because beyond the monetary rewards, which are an important source of motivation, you're also on a mission to improve humankind, and then that's a good thing. So keep doing what you're doing. The investment process exists to ensure that the best of you succeed and go on to do good with your innovations. And to those who won't succeed or don't succeed, that you realize early enough so that you can switch tags and redirect your efforts to something that will. So wishing you all the best.
Great words of encouragement there. Thank you so much, Daniel, Fong, and John, for for joining our panel today. Don't hang up. We're going to go to Q&A in a moment. We have a whole bunch of questions lined up for you, but that will be a closed door session. Thank you to all of you watching on YouTube and LinkedIn. To our cohort companies, stay back. We're going into Q&A. So thanks again, those of you watching on YouTube. Don't forget to tune in next week when we're talking about M&A and working with strategics. I'll pause here.